Welcome to the deep dive. Today, we're really plunging into something practical and honestly pretty powerful. Strategic year-end tax planning for 2025. And this dive, it's specifically tailored for you, our listener, high income, active partner in a pass-through, juggling W-2s, partnership income investments, the whole picture.
Exactly. Our mission today is to, navigate these, let's face it, complex 2025 U.S. tax rules and really zero in on the high-impact strategies. We've run the numbers, and your projected baseline federal tax, it's looking like around $291,865. So our clear goal is to bring that down significantly.
Okay, 291K. Let's unpack the basics first. The U.S. system, it's progressive, right?
Progressive, more income, potentially higher rates on parts of that income. 7 brackets, topping out at 37%.
And for 2025, married filing jointly, that 37%, that kicks in above what, about $751,600 taxable income?
That's the number, $751,600.
And quick point, credit versus deduction? A credit's always better, yeah.
Dollar for dollar reduction, always. A credit directly cuts the tax you owe. Deductions just lower the income subject to tax. Big difference. And for high earners like you, that adjusted gross income, your AGI, it's like ground zero. So many things get limited based on that number.
Right, AGI. It dictates a lot.
And also need to keep an eye on the net investment income tax, the NIIT. 3.8% on investment income, over $250K for joint filers.
250K threshold. And you mentioned that's not indexed for inflation.
No, it isn't. Which means over time, more and more people kind of get pulled into paying it. It's a subtle creep.
Okay, now this is where it gets really, really specific to your situation as a partner in a pass-through entity. The partnership itself, it doesn't pay federal income tax, correct?
Correct. No entity-level federal tax.
Okay.
The income, the deductions, it all flows through to you, shows up on your Schedule K-1.
But here's the catch, right? The phantom income thing.
Exactly. That's the term. You're taxed on your share of the partnership's income.
Even if you never actually receive that money as a cash distribution?
Precisely. Which makes cash flow planning absolutely critical. You need cash to pay tax on income you might not have received yet. And tied to that is your basis in the partnership. Think of it like your investment track record in the business.
Okay, basis. Why is that so important?
Well, it limits how much partnership loss you can deduct, and it also determines if the cash distributions you do get are taxable or not. So, yeah, vital number to track.
Got it. Okay, foundation laid. Let's pivot to strategies. How do we actually start chipping away at that 291K projection?
All right, first up, a really big one. The PTE workaround. Pass-through entity tax.
PTET, I heard a lot about this. How's a game changer?
Okay, so many states now let the partnership choose to pay state income tax directly at the entity level.
The partnership pays the state tax instead of me personally.
Exactly. And here's the kicker. That payment the partnership makes, it becomes a federal business deduction for the partnership.
So it lowers the federal income flowing through to me on the K-1.
Precisely. Then, you usually get a credit on your state tax return for the tax the partnership paid on your behalf. So for someone like you, bumping up against that $40,000 SALT deduction cap.
Yeah, that cap hurts.
Right. This basically turns a capped personal state tax deduction into a full, uncapped federal business deduction. The savings can be huge, easily over $16,000 in your case, potentially.
Okay. That's converting a limited deduction into an unlimited one, effectively, but you need the partnership to make that election?
Yes. And often the deadlines are early, sometimes even before year end. So that's a conversation to have with your partners, like now.
Okay. PTE, top priority discussion. What's another major lever?
Retirement contributions.
Yeah.
Especially for the self-employed part of your income via the partnership. A solo 401k is incredibly powerful.
Solo 401k, how much can go in there?
For 2025, potentially up to $70,000. Plus catch-up if you're over 50. That's a massive deduction against your AGI.
$70,000. That alone could save, what, almost $26,000 in tax?
Easily. And don't forget, the standard workplace 401k for your W-2 jobs, max those out too. That's $23,500 each for 2025. And the HSA, if you have a high deductible health plan. $8,550 family limit. Stack those up.
Okay, maxing out all retirement accounts. Got it. What about the investment side? Portfolio moves.
Yep. Tax loss harvesting. Before year end, look at your non-retirement accounts. Any investments sitting at a loss.
Sell them to offset gains.
Exactly. Sell losers to offset capital gains you've realized. You can offset all your gains, plus up to $3,000 of ordinary income each year,
We projected $70 K in gains, so this could offset a good chunk of that tax.
potentially saving you over $17,000 in taxes on those gains. Just watch out for the wash sale rule. Can't buy back the same thing within 30 days.
Right, the wash sale rule. Good reminder. Okay, what about charitable giving? Any specific angle there?
Definitely. Giving appreciated assets.
Yeah.
Instead of cash, donate stock you've held over a year that's gone way up in value.
Why is that better than cash?
Two reasons. One, you still get a charitable deduction for the full fair market value of the stock. Two, you completely avoid paying any capital gains tax on all that appreciation.
Avoid the gain and get the deduction. Nice.
It's a very efficient way to give.
Okay, one last point. Timing. You mentioned something about maybe accelerating income. That sounds counterintuitive.
It usually is. Traditionally, you defer income, accelerate deductions, but the Tax Cuts and Jobs Act, many of its provisions expire after 2025.
Meaning rates might go up in 2026.
It's a definite possibility. So
Yeah.
the nuanced play for this specific year, 2025, might be to actually pull some income into 2025 to lock in current rates and maybe push deductions into 2026 if you expect higher rates then.
Interesting. A bit of strategic forecasting required there.
It's a bit more advanced, requires careful thought. But you put all these together, the PTET, maxing retirement, tax loss harvesting, smart charitable giving, the timing consideration, the potential federal tax savings, we estimate over $62,700 for 2025 based on your scenario.
Over $62,000. That's significant. It really shows what proactive planning can do.
Absolutely.
So, wrapping this up, what's the
Okay.
big takeaway for you? Clearly, the tax code's a beast, it's complex, but if you approach it strategically, like we've discussed.
It becomes a tool, a powerful tool for your financial health, not just a burden.
Right.
And maybe that leads to a final thought for you to consider. We talked a lot about current rules, some expiring soon. So in this world of changing tax laws, personal finances shifting, how does your understanding of what's temporary versus maybe permanent in the tax code shape your longer-term wealth strategy? It's not just about saving tax this year, right? It's about how you position yourself for all the years ahead, something to mull over,